Today, we're unpacking a massive financial move that's making waves in the luxury world. The giant Richemont just made a €100 million decision about one of its oldest, most prestigious brands, Delvaux. And really, the big question is, what does this tell us about where the luxury market is heading?
Just take a look at that number, 100.6 million euros. Let that sink in. That is a mountain of debt that, for one company, was just, poof, completely wiped off the books. And that brings us to the core question of our explainer today. Why on earth would a powerhouse like Richemont just forgive a debt this huge? Is this a brilliant rescue mission, a strategic masterstroke, or is it a sign of some much deeper trouble? Let's find out. Okay, so let's get right into it. First, we have to understand what exactly happened. We're talking about a huge financial intervention at Delvaux, which, by the way, is the world's oldest luxury leather goods house, founded way back in 1829. So here's the deal in plain English. Richemont, the parent company, took over €100 million of debt that Delvaux owed them and basically said, forget the loan. We'll just take a bigger ownership stake in you instead. Just like that, they made Delvaux's balance sheet look a whole lot healthier, almost overnight.
So, how does a move like this actually work? The term debt-to-equity conversion sounds super technical, right? But the idea behind it is actually pretty simple once you break it down.
At its heart, it's basically a trade. The lender, in this case Richemont, agrees to just cancel a company's debt. And in return, the lender gets a bigger piece of the company itself. They go from being a creditor to being a bigger owner.
Think about it like this. Let's say you lend a good friend some money to keep their little bookstore afloat. But business is tough, and it becomes clear they just can't pay you back. Instead of forcing them to close up shop, you say, you know what? Forget the loan. Just make me a part owner instead. Your friend is now free from that crushing debt. And you, well, you now have a real stake in the bookstore's future success. That is exactly what Richemont did for Delvaux.
And the effect? It's pretty dramatic. You look at Delvaux's books before this move, and they were just weighed down by a ton of debt. And after, that debt is gone, vanished. It instantly strengthens their financial foundation and makes the whole company look way more stable.
And here's the really crucial point to get. Richemont didn't actually spend any new cash here. They didn't write a fresh check for €100 million. This was all a paper transaction, a bit of clever financial restructuring. They just took the financial burden and absorbed it onto their own much bigger balance sheet.
Okay, so this brings up the next obvious question. How did Delvaux get into this mess in the first place? Why did they need this massive intervention? Well, the answer is a pretty classic tale of betting big on a boom market that, well, didn't boom forever.
You see, during the big luxury gold rush of the last decade, Delvaux went all in on Asia. They built out most of their stores and focused their energy on China and South Korea. And for a while, that was a brilliant strategy. But now that those economies have started to slow down, what was once a golden goose has turned into a pretty significant liability.
To really get a sense of the scale here, let's just rewind to 2021. Richemont bought Delvaux for a reported €178 million. That's a huge investment, even for a behemoth like Richemont.
But here's where it gets really eye-opening. Since that big purchase, Delvaux has racked up losses approaching €80 million. That's nearly half the purchase price just gone in only a few years. It's a pretty stark sign of just how tough things have been.
And we're not just talking about some creative accounting here. If you strip away all the financial wizardry, the reality is the core business, selling handbags, has been losing a ton of money. It shows a brand that just hasn't figured out how to make a profit without relying so heavily on those Asian markets that are now cooling off. So if the brand is losing so much money, you might be asking, why not just sell it? Cut your losses and move on. To answer that, we need to zoom out and look at Richemont's master plan, because this move is all about playing the long game.
You have to understand, Richemont is a massive, diversified empire. Their real cash cows, making up about 70% of their business, are their jewelry powerhouses. We're talking Cartier and Van Cleef & Arpels. These brands are so wildly profitable that they can easily, almost casually, absorb the losses from smaller brands like Delvaux, giving them the breathing room they need to turn things around. And this quote right here, from an analysis of their chairman's strategy, it just hits the nail on the head. By converting the debt instead of just selling the brand, Richemont is sending a crystal clear signal to the market. We are patient. We believe in this brand's potential, and we are willing to ride out the storm. And this timeline really lays out the whole story. You see the big acquisition in 2021, followed by an initial loan in 2022, and now this massive debt conversion. It's a clear pattern of continuous support.
Believe me, all eyes are going to be on their next financial results this May to see what the next chapter holds.
Okay, let's tie it all together. Why should you care about the balance sheet of one Belgian handbag maker? Because this move isn't just about Delvaux. It's a flashing neon sign about a much bigger shift that's happening across the entire luxury world.
Look, what we're seeing here is so much more than a simple rescue mission. This signals a fundamental change in strategy for the whole industry. The go-go era of just expanding aggressively, opening stores everywhere, especially in Asia, is over. The new name of the game is structural repair, fixing the foundations of these brands that maybe grew a little too fast.
And trust me, Richemont is not alone in this, not by a long shot. All the biggest names in the game, LVMH, Kering, Burberry, they're all wrestling with the exact same problem. How do you pivot after becoming so dependent on a Chinese market that's finally slowing down? Delvaux' situation is just a really clear, really public example of a problem that is facing the entire sector.
Which leaves us with one final big question. Is what Richemont did a brilliant long-term play to save a historic brand and set it up for a massive comeback? Or is it a €100 million warning sign, telling us all that the golden age of luxury might be showing some very serious cracks? The answer to that question is probably going to define the industry for years to come.